Hi everyone, welcome to my video series on finance essentials for expats in China. And today's topic is why I don't invest my money in the China market. And so don't get me wrong, I do like living in China. I love Shanghai and I do see it as my future home for the foreseeable future. And I've lived in Shanghai for more than 10 years now. But when we're talking about long-term financial planning, we're talking 20 years, 30 years from today, Chinese market might not be the best place to keep your savings for retirement or other goals. And so today's video is about that. So first, let me start with the reason number one, and that is we're all temporary in China. So even if your partner is Chinese, even if you have a permanent residency card or five-star card, if you have a stable job, you cannot with 100% confidence say that you will stay in China for the rest of your life, because things change, jobs change, family situations change, divorces happen. And also, even if you have a PR, there are certain conditions where you need to spend 3 months per year in China for that card to be valid still. And as soon as that changes, in theory, that card gets also revoked. And also, yeah, we don't know how things will go in China in the near future, right? So I wouldn't necessarily say that, oh, like I like living in China and then I'm not leaving ever, right? So we need to be prepared for the possibility that we might leave one day. And so, and when that happens, if we have our investments in China, that means that our investments needs to be sold, and you need to wait for those proceeds to be back to your bank account, and then you need to transfer that again. And I don't need to tell you that moving money out of China is difficult as it is. And so you're just creating more cash in RMB to transfer for yourself. So reason number two, as I already started, is it's difficult to get the money out, and RMBs are not really easy to exchange outside of China unless you're in a big city. Then sure, but just like last year, I was in Philippines, and in Manila it wasn't a problem, right? I was able to use my card, my Union Pay card, and I was able to exchange my RMBs. But then I went to a smaller island, Bohol, and there was already difficult, right? In major places, in some places, they were exchanging RMBs at a very unattractive uh, rate, but it was difficult. So, and I think that's just the reality of holding RMBs, because it's not very common outside of China. Then, if we have someone who has certain savings, there's a certain threshold beyond which you might be requested to provide certain documents, maybe tax receipts and employment contracts, etc. And so it's very difficult to kind of get and transfer out, even through the bank. And depending on the situation, let's imagine you're somewhere, visa didn't get extended and you need to leave, and you have certain assets that you need to sell, then wait for them to for RMBs to get added to your bank account. Then from your bank account you need to make another transfer, and depending on the situation at the time of the sell, maybe the stock market is down, that might be bad timing for you to sell your assets. So to avoid that, uh, just keep your savings outside and in the investment as well. just to avoid this kind of situation where you need to move your money very quickly. And unfortunately, not a lot of people who have to leave have that time for them to wait for the RMBs to get back to their account, etc. So unfortunately, in some situations, it's more urgent, and so just avoid putting yourself in that kind of situation. So reason number three is that the Chinese market is quite different. So compared to developed markets in the West, in Europe, it's very different. And because of how it's controlled, how it's influenced by the government, the stock market is it's not as predictable as you might expect from somewhere else. Then auditing and information standards in China are also different. And therefore, when a company, for example, um, Nvidia or Tesla, when they make announcements on their earnings, it could be a good indicator of how the company is doing, or generally, there is a public information that you can use to make an investment decision whether or not to invest in this company or the funds. And then generally, when we're looking at economies, in developed economies, uh, typically there is some kind of independent outlook at how the economy is expected to be performing. And so there is a certain expectation that what we can expect in the future. But in China, because some of that information is not released, and it's not as transparent from the companies and from the government, so therefore it's very difficult to make any kind of decisions regarding a company. And also the changes that the government might make, it can affect certain companies, certain sectors, and the feelings of investors and the expectations of investors, they don't really matter when there are certain uh, decisions that were already made. And in this case, it just steady and more safer to go with a market where at least the information is more transparent. Now, now reason number four is there are certain opportunities outside of China that we could be and should be pursuing in terms of the growth and expected growth, and just generally what we can hope for, right? Because um, in most of the markets outside, there are companies and there are sectors that are growing rapidly, and at the same time, there are sectors that hold their value steadily for many years. And so compared to what we have in China, where the stock market is controlled by the government, and the outcome is hard to predict in the short term and in the long term as well, because of course they're trying to stimulate the economy, but at the same time there will be certain industries and certain sectors where they will be um, holding them back in a way, right? So that there are certain industries that they're not booming too much. Whereas when we're talking about the general global markets, there's just more room for certain industries to carry on, to continue growing. And it's your decision as the investor whether or not you want to take on the risk for the extra growth, or if you want to go ahead and maybe diversify yourself and have uh, smaller exposure to something higher risk, higher growth kind of asset, and have it combined with something else. or not, or go full growth, right? But either way, there is a choice, and where there are options that you can choose for your own investments. And for me, I would say that a lot of people reach out to me, who are Chinese, and that they're unable to access the international market from China, so they need to open an account somewhere in Hong Kong, for example, and it's more difficult for them. And so I think this is a advantage for expats, because we don't have that kind of limits. So we can open an international platform and invest in global companies through ETFs or stocks. So currency, as I mentioned, currency is a real risk, because holding all your savings in one currency, first of all, you're dependent on how things will go in that specific country. Then also, if all your savings are in Chinese RMB, and then you're moving somewhere where they don't trade directly, then you might have to exchange your RMBs to dollar, and then that currency, wherever you are, and then so you're losing money in between. And also, we don't know how things might go in China in the long term. So my recommendation is just keeping a combination of different currencies. Even with the dollar or even euro, we don't know how things will go. Because generally, when we're talking about financial planning, we're talking next 20, 30 more years. And no one has a crystal ball to say that USD is definitely going to continue being the dominant currency at the time. But looking at things right now, we can say that it's likely to be the same currencies, maybe not USD that will be number one. We don't know, maybe. But euro and sterling are likely to be in the mix. So if you're someone from the US, go with US dollars for your future savings, especially if you're considering going back to the US at some point. If you're European and plan to go to Europe at some point, then euro should be the base of your savings, and then you can diversify with USD in the meantime, right? Just for extra diversification. And if you're, let's say, from the UK, then sterling, again mixed with another currency like USD, for example. If you're from Asia or Latin America, generally having exposure to these currencies like USD, sterling, euro is not a problem, because these currencies are easily exchanged in any country in Latin America or Asia or Africa. And so it really depends on where you plan to be and what are your future plans. And based on that, make the choose the currency that will work best, depending where you want to be. And if you're not sure, right? So if you're someone from one country planning to be in somewhere, I just, like someone recently told me, I just know that I don't want to go back to my home country. That's fine too. In this case, just have dollars, for example, right? It's not likely to demolish or completely vanish in the next several decades. So it could be still a good place to keep your savings for the coming decades. And it is accepted and easily exchanged in most countries. So again, keep it in USD, maybe add euros or sterling in the mix, just for extra diversification. So for expats in China, my recommendation is keeping enough for emergencies, because again, you're living in China. If an emergency happens, it's likely to be happening in China. So have this cash buffer for, just in case, and it should be enough for 3 to 6 months of expenses. It could be all in RMB or combined with, part of it in RMB, part of it in your home country, in your bank account in another currency, as long as there is a Visa or MasterCard linked to it. In China, realistically, in major cities, you can use your Visa or MasterCard to pay for things, or maybe there's an emergency happening when you're traveling. So in that case, it would be helpful to keep your savings, some in RMB, some in another currency. But yeah, beyond that emergency fund, uh, keep it somewhere else. If you know for sure that after China you're going back to your home country, then I would park your savings in your home country. But if you're not sure, or maybe you're from a country where there is economical or geopolitical instability, or just things are not going great and you're not sure, then you can open an international account. So currently, I help expats opening a bank account in two neutral areas. One in the Isle of Man. It's a bank called Standard Bank, and also there's another bank called Swiss Bank, also available for long-term residents in China. So there are other two options. So you don't really have to keep all your savings in your home country, especially if you have certain reasons to not to. So go with some international account and uh, invest, right? For long term, I would go with full equity, aka invest in uh, international companies through funds or ETFs. I wouldn't go, especially if you're a beginner, I wouldn't go with stocks, because with stocks is just a different uh, beast. And so if you're a beginner, just start with ETFs and or funds. And if you want to have exposure to Chinese companies, then you can go with China A shares ETF or funds. So there are also different diversified funds where it's a mix of equity or companies, stocks, with bonds. Like there is one called Vanguard 60/40 strategies that also works for someone who's new and doesn't want to go too much on just stocks, but wants to have a general exposure to bonds. That's fine as well, right? Just research this and make sure that it matches your risk profile. And if you want to have China assets, for sure you can add China A shares. But if you are someone who's saving for retirement, I wouldn't go with very niche focused ETFs like China A shares as part of the retirement portfolio. So I would say maybe 5-10% of your overall portfolio can be exposed to China if you really believe uh, in Chinese companies. But the majority of your retirement savings should be in something global, just because it's something steady, it's something um, more predictable. Because of course we don't know how things will go, but so far, looking at the major stock markets like S&P 500, FTSE Euro stocks, there are certain paths that we can expect from these markets. And so it would be a safer bet for retirement to go with global companies versus a very focused uh, investment assets like China, because in the short term or in the medium term, we don't know how things will go. So just don't put all your eggs into one basket or into one asset or ETF like China A shares. So make sure that you are diversified. Personally, I like living in Shanghai. It's my second home, and I do see myself living in China for the foreseeable future. Life is very comfortable here, and uh, yeah, I don't see myself leaving for good anytime soon. But I am prepared for the possibility, of that changing at some point. Uh, at the very least, at some age, it's already difficult to get the visa. And from what I hear, after 55, depending on the industry, it might be already difficult. So we all need to be just prepared for that. And when we're talking about retirement, right, we need to keep in mind that our savings for retirement need to be somewhere accessible. They need to be flexible so that we have access when we get there, and we need to be diversified. So not only from the point of view of the assets that we invest in, but also currency, because realistically we don't know how things will go. But at least when you are have several options and your investments and your savings are not just in one place, you're just protecting yourself from one place, not going according to the plan. So at least you have other parts of your portfolio somewhere else. And yeah, as mentioned before, keep enough for emergencies in China. Then your cash savings, uh, short to medium term, in an international account somewhere outside of China. And depending on how the situation is in your home country, maybe somewhere else. And China exposure is optional, but if you do believe in the China market, of course, you can have um, something like China A shares ETF in your portfolio, but it wouldn't be something that all your savings are tied to. So make sure that you have different assets within your portfolio, and it's not just all about China. That's it for me for this topic today. Make sure to subscribe to my channel to receive updates of my upcoming videos. I also record podcasts and webinars, and all of that I post on this same channel. If you have a question or if you want to have a consultation with me, scan this code and connect with me in WeChat. You can also leave your questions or comments under this video. Thank you very much. Until next time.